Hello, my name is Tim Kraus with Kraus Accounting Group, and today we're going to talk about how to take care of clients after the acquisition. Most education, or most talking about acquisitions in business, always goes to the beginning. Always, that's the fun part. That's the negotiation. That's the world of possibilities. But what do you do after that? Incredibly important. When you're buying an accounting firm, retention is the deal. Keeping the clients is the whole point. Because at the end of the day, you are just buying relationships. That's it. You are not buying assets, you are ultimately buying trust. That whether it's a bookkeeping firm or a tax firm, when that seller is selling the firm to you, the buyer, they are essentially telling their clients, hey, either stay with this company or hey, now go to this other company if it's going to be a tuck-in where all of the clients will transition from brand to brand, or if it is a tuck-in, it'll be, hey, stay with this current company that we have here. So this can include moving dozens to hundreds of relationships. Done both of them. Different ways to handle those, but yes, this is a lot of relationships all at once. And almost no one transfers automatically. Unfortunately, they all have some process that they pretty much want to go through to ensure for themselves, because they hired their previous provider or the provider that you're buying the business from to do a certain job, and they trust them to do that job. And like always, every change is a negative at first. Every time. So, and then retention, from my experience, and I've bought my own, but we do about $1.5 million in revenue right now, team of about 20 or so. We have done four acquisitions, potentially working on a fifth here right now. Mostly small acquisitions, some okay sized ones, but really relatively small. So the retention happens when the clients feel comfortable that you're going to be able to provide the same services, and once you've done it for 30, 60, 90 days, that really helps the transition piece there. So when you are buying an accounting firm, or when you're selling your accounting firm, from my opinion, and I've had other videos on this as well, they're basically 4 stages. And essentially, everything from here upwards, almost no one knows about it. It's pretty quiet. Maybe the employees don't know. Definitely the clients shouldn't know in a perfect world. But once we hit under here, now we are into the implementation transition plan. This is when a lot of the work happens. You think work happens here, and it does, but a lot of the work happens in that point number 4. So this is important when you're looking at buying a firm or when you're looking at selling a firm. If you put something like this together for what is the normal for your clients, because every client and every accounting firm has a different normal, what their standard of service is. So what is your normal? And if you're looking at buying a firm, what is the normal that you're buying from another firm? There could be some where, they don't use email at all, other ones where they only use email, some where they only call on the phone. I've had some firms where 10% of the communication is through email, most of it's over the phone and through letters. Very different styles. Another one where everything's through email and done very, very quickly. But those styles are very, very different. Other firms I've purchased where, like the one we're going to talk about later, 90% of the clients met in person, versus other firms. Another firm we bought up in Seattle, they have a client come to the office every 3 months. Very rare. And document flow, essentially, what can you know that you're going to have to shift in your business, or how you're going to do things with the move over. And then service expectations, bookkeeping, accounting, CFO mean different things to everybody. So if you could break those down when you're looking at buying a firm or when you're looking at selling your firm, to what does this actually mean? Does bookkeeping by default mean ARAP? We had one seller, he called all of his things financial management services. But for some people, he filed the DOR for them once a quarter. For other people, he did 10 checks a day in AP, or 10 to 15 checks a week, really. In AP, full bookkeeping, AR, everything, both called financial management services. Also no written engagements, but that's a different story. What does basically the client expect by the words that we said that we're going to be doing for them? We're going to be doing their taxes. Some people, that is, for most people, it's just the federal end of year taxes. For some people, it's doing the federal end of year taxes and doing the quarterly business taxes. For some people, it's doing the federal end of year quarterly business and also their 1099s. Everyone's different. Figure out for the firm that you're buying what they have defined and what they have got their clients used to. So, huge piece with retention, minimizing surprises. There will be certain things that you will have to change, but minimizing the surprise aspect of it is going to be super important. Because clients fear disruption, they fear change, they worry about price changes. This is something I will hit very early on. Oftentimes we bought a small tax firm, and in the letter we literally say that, hey, for in this scenario where it worked out, other scenarios it doesn't, but hey, we're going to be honoring the price that you guys paid last year. Also, for the process, this is how you can do basically the same process that you're used to. You're used to 90% in person. We're used to 90% virtual. To set up an in-person meeting, call this person, they'll be on the schedule, and we'll go from there. Your job is to reduce that uncertainty fast. Like I said, that was in the letter that the tax firm sent out, the letter/email that they sent out to all of their clients. That was, hey, I can't do this work for you anymore. We'd love to working with you. Here's where you should go. Here's how it's going to happen. It's right there in the next paragraph. Super important with that. So, and for my buyers out there, what you need to figure out is what is your willingness? What things must change right away? Probably not very many. Good idea to have be not very many if you want to have higher retention. And then what are you not willing to do, and how are you going to communicate it out of those things that you're not willing to change? And then who on your team is going to handle that? Like I mentioned before, in the letter that we sent off, we had actually 2 team members that people can reach out to, that then they could schedule their in-person meetings. And how many meetings are you and calls you're going to realistically support? In most firms that we have purchased, there is a large amount of uncertainty and a large amount of communication that has to happen right at the beginning, so be prepared for that. Try to time it well. If you're a tax firm, for one of the tax firms we bought, small one, we let everyone know in August because it was that time of the year and it made it much easier for that transition to be more gradual. The other one we bought in January because extenuating circumstances, we had no other choice. So we just had to be prepared for that. So typically, my approach in year 1, because in the first year, the first service providing, like if you're looking at the first couple months in bookkeeping or the first year in tax, the client has the question of, can you even do the job? They do not care if you are licensed. Literally don't. We have bought firms from people who have EAs. We have bought an EA license. We have bought firms from people who don't have any sort of license. My partner has a CPA license. They still ask if she could do the job. Doesn't matter. Not at all. That doesn't matter. So, oftentimes we will keep the price same for the first year. It does have one less thing. We'll also sometimes, if they have an office, we might keep an office for one more year if that's what they're used to and if it's not too expensive, just to help minimize changes that first year. So, and if we can, try to mimic the patterns as much as possible. This is where I go to. They say, before you innovate, imitate. But for me, we kind of do imitation, recreation, then innovation. So that we can actually hopefully move people through the process, but we want to know why in the world the current seller did that process. Oftentimes you'll talk to the seller about why they did the process, and they might not even fully realize, but then we could take it from there. Also, if the seller raises prices annually, I like to continue that cadence. We bought a firm, now a lot of those clients were way underpriced, but she did raise prices annually some, so we did raise it for that particular one. Also, we were okay with the risk in that scenario. So this is very important between the buyer and the seller. The seller, you and the seller, should really know what this plan is going to look like. Because if you surprise the seller, everyone trusts them. And if you pull the wool over their eyes, try to pull the rug out from underneath them, any phrase you want to say there, it will not be a good thing. So make sure that you both have agreement with, hey, this is how we're going to do the introductions. So, and then once the introductions are planned, figure out how they're going to happen. And then how in the world you're actually going to communicate. Again, in the letter we had, you can email us, you can call us, you can write us a letter. We have different ways it's going to be coming in. And then also knowing how long the seller is going to be willing to support you, whether it's going to be a few months, just a few weeks, not at all, or potentially up to a year. So these are a couple ways that the seller of the firm can introduce the new owner. So, and we've had all these ways here. There is the high touch, the call and meet with every client. We've had mixed results with this. We've had really high retention results with this for the most part, but we've also had it where sometimes some of the clients will think that, oh, you're not really selling. Oh, but you're selling for everyone else, just not for me. So you have to, if you're a buyer, also run through a few of these scenarios with the seller to let them know what they should be expecting. If you're a seller, you're going to be getting that question. I know you're retiring. I know you want to spend time with your grandkids, but you can still do my tax return. It's really easy. Sorry, no, I can't. I'm moving on. My license is expiring this year. I'm not renewing it. Kind of having your back pocket that phrase, because you will have some of those clients who want to do that, and that's great. That means you did a good job as a seller, as an owner of the firm. But it's good to have that plan because it will come up. We've done group office hours before. Those have been fine. We've had, if the seller is nearby, we've had them come over to our office for certain client meetings that were important. And then there is just simply the announcement and optional phone calls. Again, depends on the situation. The announcement one is nice because it's the least amount of work for the seller. They just let everyone know, and there you go. But it can sometimes have the lower retention because honestly, sometimes the clients, as you well know, working in accounting, will miss the email or miss the mail. And then so they might be thinking that you're still providing the service for them or providing the taxes for them. And they might come back a couple months later saying, what the heck's going on? So with the low touch one, we definitely encourage a follow-up from the seller if we don't hear anything after a few weeks. So, and then for that example here, the one that we're going through right now, they are used to everyone being local, which is fine, 90% meeting in person. And so what we did is we set up, me and my partner, set up with our team, multiple in-person meeting days throughout the next couple months. It is middle of February, so we are in tax season right now. We set up meeting days so we know when we're going to be meeting with these people, and then we let them choose times within there because we wanted to basically batch those as much as possible. And then we did train our team with how the workflow goes. The team actually did a really great job making a really nice Excel spreadsheet where we can keep track of all these things, which has been helpful. So in general, the first 30 days of real service providing is going to be extra clear, and the clients are going to be, can you actually do what you said you're going to do? Okay. So this could be in your announcement. What should they be expecting? How are they going to be able to interact with your business? Who are they going to be talking to? And then offer a way for them to reach out to you in any way they want to. As long as it makes sense. Again, you have it within your structure because you still have your business to run. And then make sure that your team is responsive, because if they're not responsive, especially in this time when there's no relationship yet, they will go other places very quickly. Okay, and then when you're at the 60, 90 day mark, basically this is more for bookkeeping flows where you've done it for a couple months. This is where you're going to be matching. Make sure you can match the expectations that make things easier. If you're going to make things easier through software and different things, just make sure they understand what is going to change, because there will always be change. We're moving people from QuickBooks Desktop to QuickBooks Online, and they didn't like how some things looked. So even though they asked for QuickBooks Online, and QuickBooks Online in some ways is better, it's different. It's different, but also QuickBooks Desktop is going away, so it is what it is. We just had to make sure that we had a clear expectation, or we could have done a better job making expectations clear with that client. So standardizing your workflows, introducing the team intentionally, and then identifying who are the high-touch clients and how to protect them or work with them. And then start subtle, that's the key word here, improvements. Originally, I'm a big systems guy, and I really thought that I would be able to go into a new business that we bought and do a total overhaul as fast as I would be able to write the SOPs. And that is not the case, unfortunately. I wish it was, but I have not found that to be the case so far. Maybe someone else does, and good for them, but that has not been my experience so far. So in my opinion, retention is created by 4 things. Basically communicating very consistently and clearly what's happening, giving a predictable process so the clients feel comfortable about what's going on. If you can, having a clear scope. This is also if the seller doesn't have engagement letters, which if you're selling a firm, please have engagement letters because it's helpful to know what the next person is supposed to do. But having a clear scope of what's included is very important because trust me, when you have a client come to you and say, okay, has this been filed? And we're like, we had no idea this was a thing, which has happened 100%. And then we fix it and we file it and we do what we got to do, but like it doesn't make the buyer look good. So please help the buyer look good, because you as the seller, retention is super important for you too, because all the firms I buy have some form of seller financing. And so having the retention allows the buyer to be able to then pay the seller for the firm. So, and this is basic business as well, just competent delivery, doing what you say that you would do. And then the buyer's job is to protect the normal, then improve it over time. Figure out what they're used to, then improve it. Or else you're going to be in a world of hurt very quickly. So, and this is going to happen through talking to the seller, find out what's normal during that discovery, building a plan with your team, what your team can actually deliver, and then having that in agreement with the seller, make sure this is the right plan here, and then actually do the plan the best you can. Things will change, trust me. And then once everything is stable and you'll feel it, then you can start improving things. There's a couple things in the firm that we bought up in Seattle that I want to improve on, especially with some of their credit card handling, especially with some of their software. But we're making sure things are stable first, and then we'll improve on them. That should happen hopefully this summer, fingers crossed. But yeah, so this is kind of a guide that I have on how to take care of clients after the acquisition. This is when a lot of the work starts. This is like when you're getting married. Everyone likes to talk about the dating and all that stuff, and that's all the pre-work, which is great and needed. But once you say I do, whether it's to a spouse or to a business, this is when the real work starts, in my opinion. So this is a little bit of some of the things we do for client to help client retention after the acquisition. My name is Tim Kraus with Kraus Accounting Group. If you potentially have an accounting firm that you would like to sell or downsize, or some clients you'd like to, refer out, we'd be interested to find out. We'd be interested to hear from you. Please reach out, and I'll talk to you later. Thank you. Bye.